Every golfer needs to know they have their best clubs in their bag. But Kevin, when it comes to mortgages, there's a silent driver. Tell us about the word of the day.
The word of the day is going to be spread. Spread is the difference between that 10-year Treasury and what the bank is willing to pump out long-term interest rates for. The spread typically sits around 1.5 to 1.8, but when times of uncertainty, like sticky inflation, you're going to see that spread increase. Right now, you're seeing it hover between 2.5% and 3%. This is what I'm talking about. The green is the 30-year mortgage rate. The blue is the 10-year Treasury. That difference between those two is the spread. That is what the bank is willing to push that rate out for based on risk. And the reason that this is important, and I talk about it often, where you should potentially use yield spread to cover closing costs. As the economy rights itself, inflation starts to come down, jobs, we get back to a healthy economy, that spread by the bank is going to decrease. And if that gets to 1.5%, we're sitting at 4 right now today. We be at interest rates of 5.5% right now. Once the risk goes away, combined with a lower Fed funds rate, it's going to be fantastic for interest rates. And that's why I predict in 2026, we're going to be near the mid 5s to 6% on conventional loans.
The spread is the silent driver behind where the mortgage rates are today and where they're headed next.
The spread is the risk that the lenders believe that they need to bake in so that they secure themselves from any default, any changing conditions, and the spread becomes less when there's less uncertainty in the marketplace. So not only is the Fed funds rate going to be coming down, that spread, that difference is going to get smaller as well, which is also going to drive rates lower in the future. As that 10-year Treasury comes down, that's why interest rates are coming down. But if there was less uncertainty right now, rates would probably be 0.5 point lower.